The latest Kagiso Purchasing Managers Index numbers are showing signs of positivity. In February, the index increased by 4.5 points to reach 53.6. The figure increased for the second consecutive month and rose above the key 50-point mark for the first time since August 2012. Joining us now from Cape Town is Abdul Davids. He's head of research at Kagiso Asset Management and is joining us to unpack these numbers, of course. Abdul, thanks so much for joining us. Just how optimistic are you that we're now on a new path as we venture into or further into 2013?
Thank you very much. Yes, we certainly hope that we are on a new path. If one looks at the headline number at 53, just over 53, as you've mentioned, it came as a pleasant surprise. But across the board, we saw most of the sub-indices actually showing improvements from the January levels, which points to an all-round sort of improvement in business conditions and manufacturing levels as well.
What's really stood out is the kind of demand we've been seeing for locally manufactured goods in particular. So take us through what's been driving that momentum specifically, because one assumes that to a large extent we've got to take into account the kind of rand weakness we've seen over the period.
That's right. And what we have seen is a particular trend in the fourth quarter last year. From October onwards, we saw the PMI numbers weakening. And obviously the December number was fairly weak as well. So I think what happened, and we know from the mining industry, some of the big mining companies, they took their Christmas breaks about a week earlier as well. So that winding down that we saw in December last year meant that we were due for a pickup in the January-February period from the mining sector in particular. And I think given the many disruptions and the labor unrest that we saw last year, we were always due for a pickup, especially from the mining sector, but also sectors serving the mining industry as well. And then, as you rightly say, we've seen the weaker currency. The currency has been weak now for quite a number of months. You have to go back to sort of April levels last year to see the rand, for example, below the 8 rand level. So that means that maybe customers have become used to the weaker rand, and obviously manufacturers have adjusted to the weaker rand as well.
What that brings to the table is price competitiveness if you're comparing locally produced goods to those that are being imported specifically. But it's interesting that that is highlighted in the report, because having said all of that, you've got local producers having to deal with input cost pressure in a very big way.
Yes, and I think anecdotally, I mean, when we speak to manufacturers, they've done a fantastic job sort of absorbing a lot of these input cost pressures as well. We've now been living with high oil prices for a number of months, and I dare say a number of years now as well. The weaker currency obviously exacerbate the impact of the weaker oil price in rand terms as well. And unfortunately, we see further oil price pressures coming through in the coming months. But having said that, as I said, we've seen the manufacturers absorb a lot of these input price pressures as well. And additionally, what we have seen is that they've been quite prudent in terms of their capital allocation as well. So a lot of, unfortunately for the economy as a whole, we have seen underinvestment in terms of capital infrastructure. But it does mean that a lot of the manufacturers, their balance sheets are a lot healthier than what it would have been had they been on a capital spending spree, for example. And it means that prudent capital management has contributed to an improvement in the manufacturing sector as well.
While that diligence has managed to filter through, Abdul, how difficult do you see this being, or how difficult do you see it being able to maintain this kind of diligence moving forward? We saw yesterday NERSA come through with an approval of a tariff hike on the electricity front. Yes, coming in, at half the rate that Seckam had requested, but 8% still substantial increases that we're looking at.
That's right. And obviously, given the base effects, I mean, we've had 25% plus for a number of years now as well. So if you compare our electricity prices, say 5 years ago, it's obviously a lot higher than what it was 5 years ago. So even an 8% increase on this enlarged base is quite substantial in sort of absolute terms as well. But again, speaking to manufacturers and some of the mining companies, they've actually penciled in sort of 16% increases for the next 3 years. So clearly this is quite a positive for their budgets and their forecasting sort of numbers. And hopefully they'll be spending those sort of savings that they're making in terms of electricity in other areas as well.
Maybe other areas like job creation, because that seems to be something that's still proving to be quite a challenge to get up. Employment on that or on the employment front, we've got that index reporting at 45.7, and that discouraging, one would assume.
although it has improved for the month, but like you rightly say, we obviously look at the absolute level and it's still in contractionary mode. I think one of the issues that we grapple with as a country is that unfortunately, and we find this in the manufacturing sector as well, we have a surplus of labor, but the labor that we have is not of the right type. And what I mean by that is that you typically find, unfortunately, oversupply of unskilled labor and a shortage of skilled labor, for example. So clearly there needs to be a lot of investment in terms of reskilling and obviously education in the sector as well. But having said that, I think the other issue that we have is that capacity utilization is picking up quite nicely. And if this trend continues, there'll come a time where obviously there will be a shortage of labor across all sort of divisions. And that will mean that labour should improve from there.
Abdul, where we had the Finance Minister deliver his budget for 2013, how do you see the budget that was presented catering to the needs of the manufacturing industry moving forward?
I think there's quite a few sort of bright lights in terms of the budget. Clearly in terms of the spending and the need for government to really focus on infrastructure spending, and obviously setting clear targets in terms of that as well. I mean, there's been talk about obviously infrastructure spending for the last number of years, but nothing has been forthcoming. So putting clear targets to that means that there will be a concerted effort in terms of spending on infrastructure, and that will be obviously massively positive for the manufacturing sector. Additionally, we think that the youth job subsidy, if I can call it that, obviously they're using different terms for these things, would obviously be a positive as well, because hopefully it will enable some skills to come to the industry, but also more importantly some experience. Because the best sort of skills that we can get in the industry is obviously experience as well. So those two components we think will be key ingredients in driving employment levels in the industry and also to improve activity levels as well.